Greetings to everyone. Today's lecture is on the topic of export-import regulation. Have you ever thought what policymakers always keep discussing about global trade? So, how can global trade be influenced by policymakers by enactment of laws? The subject experts is Dr. Sarvesh Kumar, Assistant Professor, Department of Marketing and Supply Chain Management, School of Business and Management Studies, Central University of Himachal Pradesh, and I am Shivangi Anand. In this lecture, we will be covering the basic definition of export-import regulation. Following content in brief summarize the structure as follows. First, exports and imports. Second, acts related to export and imports in India. Third, why exports is good. Fourth, how imports is important. Fifth, DGFT. Sixth, total exports imports data of India. Seventh, guidance note for importers and exporters after GST. A. Imports under GST. 1. Duties at the time of import. 2. Duty calculation. 3. Changes in import procedures. B. Exports under GST. 1. Drawback. 2. Change in export procedures. Imports and exports are the two important components of a foreign trade. Foreign trade is the exchange of goods and services between the two countries across their international borders. Imports imply the physical movement of goods into a country from another country in a legal manner. It refers to the goods that are produced abroad by foreign producers and are used in the domestic economy to cater to the needs of the domestic consumers. Similarly, exports imply the physical movement of goods out of a country in a legal manner. It refers to the goods that are produced domestically in a country and are used to cater to the needs of the consumers in foreign countries. Thus, the imports and exports have made the world a local market. The country which is purchasing the goods is known as the importing country, and the country which is selling the goods is known as the exporting country. The traders involved in such transactions are importers and exporters respectively. In India, exports and imports are regulated by the Foreign Trade, that is the Development and Regulation Act 1992, which replaced the Imports and Exports Control Act 1947 and gave the Government of India enormous powers to control it. The salient features of the Act are as follows. It has empowered the central government to make provisions for development and regulation of foreign trade by facilitating imports into and augmenting exports from India and for all matters connected therewith or incidental thereto. The central government can prohibit, restrict, and regulate exports and imports in all or specified cases as well as subject them to exemptions. It authorizes the central government to formulate and announce an export and import, that is the exempt policy, and also amend the same from time to time by notification in the official gazette. It provides for the appointment of a Director General of Foreign Trade by the central government for the purpose of the Act. He shall advise central government in formulating export and import policy and implementing the policy. Under the Act, every importer and exporter must obtain an Importer-Exporter Code Number, that is the IEC, from Director General of Foreign Trade or from the officer so authorized. The Director General or any other officer so authorized can suspend or cancel a license issued for export or import of goods in accordance with the Act. But he does it after giving the license holder a reasonable opportunity of being heard. As per the provisions of the Act, the Government of India formulates and announces an export and import policy, that is the exempt policy, and amends it from time to time. Exempt policy refers to the policy measures adopted by a country with reference to its exports and imports. Such a policy becomes particularly important in a country like India, where the import and export of items plays a crucial role not just in balancing budgetary targets but also in the overall economic development of the country. The principal objectives of the policy are to facilitate sustained growth in exports of the country so as to achieve larger percentage share in the global merchandise trade, to provide domestic consumers with good quality goods and services at internationally competitive prices, as well as creating a level playing field for the domestic producers. To stimulate sustained economic growth by providing access to essential raw materials, intermediates, components, consumables, and capital goods required for augmenting production and providing services. To enhance the technological strength and efficiency of Indian agriculture, industry, and services, thereby improving their competitiveness to meet the requirements of the global markets. To generate new employment opportunities and to encourage the attainment of internationally accepted standards of quality. Besides this act, there are some other laws which control the export and import of goods. These include Tea Act 1953, Coffee Act 1942, the Rubber Act 1947, the Marine Products Export Development Authority Act 1972, the Enemy Property Act 1968, the Export, that is the Quality Control and Inspection Act 1963, the Tobacco Board Act 1975. At the central level, the Ministry of Commerce and Industry is the most important organ concerned with the promotion and regulation of the foreign trade in India. Within the ministry, the Department of Commerce is responsible for formulating and implementing the foreign trade policy. The department is also entrusted with responsibilities relating to multilateral and bilateral commercial relations, state trading, export promotion measures, and development and regulation of certain export-oriented industries and commodities. The matters relating to foreign trade are dealt with by the following divisions of the department: Administrative and General Division, Finance Division, Economic Division, Trade Policy Division, Foreign Trade Territorial Division, Export Products Division, Export Industries Division, Export Services Division, Supply Division. India's economic structure today presents a distinctly different picture from what it was in 1991 when economic reform started. Laws were framed to streamline the process of export and import. The Export and Import Policy, or the EXIM policy, 1992 till 1997 was a significant landmark in India's economic history. For the first time, conscious effort was made to dismantle various protectionist and regulatory policies and accelerate the country's transition towards a globally oriented economy. This policy coincided with the 8th five-year plan and has yielded impressive growth in exports. While India's total exports during 1991 till 1992 were $17.86 billion, they increased to $155 billion in 2007 till 2008, almost 2.5 times of the figure 4 years ago. Keeping these factors in view, the EXIM policies announced thereafter have sought to consolidate the gains of the previous policy. They aim to further carry forward the process of liberalization, with the result that we have achieved nearly 1.5% share of world merchandise trade in 2007 and 8, totaling up to $525 billion. In the current foreign trade policy, two major objectives have been outlined. First, to double our percentage share of global merchandise trade within the next 5 years, and second, to act as an effective instrument of economic growth by giving a thrust to employment. In the era of globalization and WTO regime, many Asian countries have achieved such remarkable export-led growth. WTO is the largest body of world trade consisting of 153 member countries as on date and responsible for 96% of the world trade. Exports therefore are of importance and are considered a national priority by the Government of India. By accepting membership of the World Trade Organization, that is WTO, India has become a part of the global village. The FDI inflows into the country from 1991 to June 2008 stand at more than $89 billion. We have witnessed a major change in this area between the years 1992 till 2007, and if one scans through the newspapers, one will find that economic news has taken priority over political news. The area in which the imports are almost essential are defense requirements, crude oil, fertilizers, capital goods, industrial inputs like raw materials, components, consumables, spares, etc., import of samples, import of technology, import of drawing and designs, import of services, etc. There are many vital areas where there is a need to import capital goods, new as well as second-hand, in order to upgrade our products and services. Likewise, in the case of contract manufacture, a firm makes a contract with another firm abroad whereby the contracted party manufactures or assembles a product on behalf of the contractor. The contractor retains full control over marketing and distribution, whilst the manufacturing is done by the local company. The advantages of such outsourcing are: there is no need to invest in plant overseas, the risk of assets expropriation are minimized, risks associated with currency fluctuations are better managed, control of marketing is retained by the contractor, a product manufactured in the overseas market may be easier to sell, especially to government customers. Lower transport costs and sometimes lower production costs can be obtained. To sum up, it is not possible to survive without imports when the world is moving so rapidly towards globalization and liberalization. Directorate General of Foreign Trade, that is DGFT organizations, is an attached office of the Ministry of Commerce and Industry and is headed by Director General of Foreign Trade. Right from its inception till 1991, when liberalization in the economic policies of the government took place, this organization has been essentially involved in the regulation and promotion of foreign trade through regulation. Keeping in line with liberalization and globalization and the overall objective of increasing exports, DGFT has since been assigned the role of facilitator. The shift was from prohibition and control of imports or exports to promotion and facilitation of exports or imports, keeping in view the interests of the country. Department of Commerce Export-Import Data. Total trade, top countries, dated 09/07/2017, values in rupees crore, year 2016 till 2017. The purpose of this guidance note is to bring clarity about the impact of GST, which would come into force with effect from 01/07/2017 for importers and exporters. On the import side, there would be no impact on levy of basic customs duty, education cess, anti-dumping duty, safeguard duty, and the like. However, the additional duties of customs, which are in common parlance referred to as countervailing duty, that is the CVD, and special additional duty of customs, that is SAD, would be replaced with the levy of integrated goods and services tax, that is IGST, barring a few exceptions. On the export side, export would be treated as zero-rated supply. Under zero-rated supply, IGST paid on export goods or the input tax credit proportionate to the goods and services consumed in goods exported under bond or LUT would be refunded. A brief summary of the changes that would impact importers and exporters upon rollout of GST are encapsulated. In the GST regime, IGST and GST compensation cess will be levied on imports by virtue of subsections 7 and 9 of Section 3 of the Customs Tariff Act 1975. Barring a few commodities such as pan masala, certain petroleum products which attract levy of CVD, the majority of imports would attract levy of IGST. Further, a few products such as aerated waters, tobacco products, motor vehicles, etc. would also attract levy of GST compensation cess over and above IGST. IGST and GST compensation cess, wherever applicable, would be levied on cargo that would arrive on or after 1st July 2017. It may also be noted that IGST would also be levied on cargo which has arrived prior to 1st July, but a bill of entry is filed on or after 1st July 2017. Similarly, ex-bond bill of entry filed on or after 1st July 2017 would attract IGST and GST compensation cess, as applicable. In the case where cargo arrival is after 1st July and an advance bill of entry was filed before 1st July, along with the payment of duty, the bill of entry may be recalled and reassessed by the proper officer for the levy of IGST and GST compensation cess as applicable. Duty calculation. IGST rate. IGST rates have been notified through notification 01/2017 integrated tax rate dated 28/06/2017. IGST rate on any product can be ascertained by selecting the correct serial number as per the description of goods tariff headings in the relevant schedules of the notification. Importers are advised to familiarize themselves with IGST and GST compensation cess rates, schedule and exemptions which are available on CBEC website. The customs duty calculator would be made available on CBEC and iSgate website. There are 7 rates prescribed for IGST: nil, 0.25%, 3%, 5%, 12%, 18% and 28%. The actual rate applicable to an item would depend on its classification and would be specified in schedules notified under Section 5 of the IGST Act 2017. The rates applicable to goods of Chapter 98 are as 9801 project imports 18%, 9802 laboratory chemicals 18%, 9803 passenger baggage nil rate, 9804 specified drugs and medicines for personal use 5%, 9804 other drugs and medicines for personal use 12%, 9804 all other dutiable goods for personal use 28%. Likewise, different rates of tax have been notified for goods attracting compensation cess, which is leviable on 55 item descriptions of supply. These rates are mostly ad valorem, but some also attract either specific rates, example coal, or mixed rates, that is ad valorem plus specific, as for cigarettes. The coverage of the goods under GST compensation cess is available on CBEC website along with their HSN codes and applicable cess rates. The IGST rates of goods, chapter-wise IGST rate, GST compensation cess rates, IGST exemption or concession are available on CBEC website for trade and departmental officers as well. IGST is leviable on the value of imported goods, and for calculating integrated tax on any imported article, the value of such imported goods would be the aggregate of: first, the value of imported article determined under subsection 1 of section 14 of the Customs Act 1962 or the tariff value fixed under subsection 2 of that section. Second, any duty of customs chargeable on that article under section 12 of the Customs Act 1962 and any sum chargeable on that article under any law for the time being in force as an addition to or as duty of customs but does not include the tax referred in the subsection 7, that is IGST, and subsection 9, that is the compensation cess. The value of the imported article for the purpose of levying GST compensation cess shall be assessable value plus basic customs duty levied under the Act and any sum chargeable on the goods under any law for the time being in force as in addition to and in the same manner as a duty of customs. These would include education cess or higher education cess as well as anti-dumping and safeguard duties. The inclusion of anti-dumping duties and safeguard duty in the value for levy of IGST and compensation cess is an important change. These were not hitherto included in the value for the levy of additional duty of customs, that is CVD, or special additional duty, that is SAD. The IGST paid shall not be added to the value for the purpose of calculating compensation cess. Although BCD, education cesses and IGST would be applicable in the majority of cases. However, for some products, CVD, SAD or GST compensation cess may also be applicable. Importer-Exporter Code, that is IEC, in GST regime, GST-IN would be used for credit flow of IGST paid on import of goods. Therefore, GST-IN would be the key identifier. DGFT in its trade notice number 9 dated 12th of June 2017 has stated that PAN would be the Import-Export Code, that is IEC. However, while PAN is identifier at the entity level, GST-IN would be used as an identifier at the transaction level for every import and export. Further, in scenarios where GST-IN is not applicable, UIN or PAN would be accepted as IEC. It is advised that all importers need to code GST-IN in their bills of entry in addition to IEC. In due course of time, IEC would be replaced by PAN or GST-IN. Bill of entry regulations and format. To capture additional details in the bill of entry such as GST-IN, IGST rate and amount, GST compensation cess and amount, the electronic as well as manual formats of bill of entry, including courier bill of entry, are being amended. Import under export promotion schemes and duty payment through exempt scripts. Under the GST regime, customs duty will be exempted on imports made under export promotion schemes, namely EPCG, DEEC, that is Advanced License, and DFIA. IGST and compensation cess will have to be paid on such imports. The exempt scripts under the export incentive schemes of Chapter 3 of FTP, for example, MEIS and SEIS, can be utilized only for payment of customs duties or additional duties of customs on items not covered by GST at the time of import. The scripts cannot be utilized for payment of integrated tax and compensation cess. Similarly, scripts cannot be used for payment of CGST, SGST or IGST for domestic procurements. In GST regime, input tax credit of the integrated tax, that is IGST, and GST compensation cess shall be available to the importer and later to the recipients in the supply chain. However, the credit of basic customs duty, that is BCD, would not be available. In order to avail ITC of IGST and GST compensation cess, an importer has to mandatorily declare GST registration number, that is GST-IN, in the bill of entry. Provisional IDs issued by GST-IN can be declared during the transition period. However, importers are advised to complete the registration process for GST-IN as ITC of IGST would be available based on GST-IN declared in the bill of entry. Input tax credit shall be availed by a registered person only if all the applicable particulars as prescribed in the invoice rules are contained in the said document and the relevant information as contained in the said document is furnished in form GSTR2 by such person. Customs EDI system would be interconnected with GST-IN for validation of ITC. Further, bill of entry data in non-EDI locations would be digitized and used for validation of input tax credit provided by GST-IN. no amendments have been made to the drawback provision Section 74 or Section 75 under Customs Act 1962 in the GST regime. Hence, the drawback scheme will continue in terms of both Section 74 and Section 75. Option of all industry rate, that is AIR, as well as brand rate under Section 75 shall also continue. Drawback under Section 74 will refund customs duties as well as integrated tax and compensation cess paid on imported goods which are re-exported. At present, duty drawback scheme under Section 75 neutralizes customs duty, central excise duty and service tax chargeable on any imported materials or excisable materials used or taxable services used as input services in the manufacture of export goods. Under GST regime, drawback under Section 75 shall be limited to customs duties on imported inputs and central excise duty on items specified in the 4th schedule to Central Excise Act 1944, that is the specified petroleum products, tobacco, etc., used as inputs or fuel for captive power generation. Exporters also have the option of claiming only the customs portion of AIR and claim refund or ITC under GST laws. All industry rates for the transition period shall be notified before 1st of July 2017. The AIR for post-transition period shall be notified in due course of time. It could be possible that export goods may be manufactured by using both central excise or service tax paid and CGST or IGST paid inputs and input services, or only CGST or IGST paid inputs and input services. In such situation, an exporter opting to claim composite rate of duty drawback during transition period has to give specified declaration and produce certificates as stated above so that he does not claim double benefit. The exporter will have to reverse the ITC if any availed and also ensure that he does not claim a refund of ITC or IGST. Requisite certificate from GST officer shall also be required to this effect. As mentioned, exporters will also have the option of claiming credit or refund of CGST or IGST and claim customs rate drawback. Under GST regime, exports would be considered as zero-rated supply. Any person making zero-rated supply, that is any exporter, shall be eligible to claim a refund under either of the following options, namely: A. He may supply goods or services or both under bond or letter of undertaking subject to such conditions, safeguards and procedure as may be prescribed without payment of integrated tax and claim refund of unutilized input tax credit. B. He may supply goods or services or both subject to such conditions, safeguards and procedure as may be prescribed on payment of integrated tax and claim refund of such tax paid on goods or services or both supplied in accordance with the provisions of Section 54, Refunds of the Central Goods and Services Tax Act or the rules made thereunder, that is the Refund Rules 2017. For the option A, the procedure to file refund has been outlined in the refund rules under GST. The exporter claiming a refund of IGST will file an application electronically through the common portal either directly or through a facilitation center notified by the GST Commissioner. The application shall be accompanied by documentary evidence as prescribed in the said rules. Application for refund shall be filed only after the export manifest or an export report, as the case may be, is delivered under the Section 41 of the Customs Act 1962 in respect of such goods. For the option B, the shipping bill filed by an exporter shall be deemed to be an application for refund of integrated tax paid on the goods exported out of India, and such application shall be deemed to have been filed only when the person in charge of the conveyance carrying the export goods duly files an export manifest or an export report covering the number and the date of shipping bills or bills of export and the applicant has furnished a valid return. For both option A and B, exporters have to provide details of GST invoice in the shipping bill. ARE1, which is being submitted presently, shall be dispensed with except in respect of commodities to which provisions of Central Excise Act would continue to be applicable. Electronic as well as manual shipping bill formats, including courier shipping bill, are being amended to include GST-IN and IGST related information so as to ensure that the export benefits like a refund of IGST paid as well as accumulated input tax credit can be processed seamlessly. In the context of GST, taking into account the obligation of filing GSTR1 and GSTR2 by exporters who are registered under GST, Board intends to simplify the procedure relating to factory stuffing, hitherto carrying out under the supervision of Central Excise Officers. It is the endeavour of the Board to create a trust-based environment where compliance in accordance with the extant laws is ensured by strengthening risk management system and intelligence mechanism of the department.